Ladies and gentlemen, good morning, good afternoon, and good evening. Today we will talk about Chapter 13, Part 1. Stay Strong! Handicapping the Financial Race. A primer in understanding and projecting returns from stocks and bonds. No man who is correctly informed as to the past will be disposed to take a morose or desponding view of the present. Thomas B. Macaulay, History of England. This is the chapter where you learn how to become a financial bookie. Reading it will still leave you unable to predict the course of the market over the next month or the next year. No one can do that, but you will be able to better the odds of constructing a winning portfolio. Although the price levels of stocks and bonds, the two most important determinants of net worth, will undoubtedly fluctuate beyond your control, my general methodology will serve you well in realistically projecting long-run returns and adapting your investment program to your financial needs. What determines the returns from stocks and bonds? Very long-run returns from common stocks are driven by two critical factors: the dividend yield at the time of purchase, and the future growth rate of earnings and dividends. In principle, for the buyer who holds his or her stocks forever, a share of common stock is worth the present, or discounted, value of its stream of future dividends. Recall that this discounting reflects the fact that $1 received tomorrow is worth less than $1 in hand today. A stock buyer purchases an ownership interest in a business and hopes to receive a growing stream of dividends. Even if a company pays very small dividends today and retains most, or even all, of its earnings to reinvest in the business, the investor implicitly assumes that such reinvestment will lead to a more rapidly growing stream of dividends in the future, or alternatively to greater earnings that can be used by the company to buy back its stock. The discounted value of this stream of dividends, or funds returned to shareholders through stock buybacks, can be shown to produce a very simple formula for the long-run total return for either an individual stock or the market as a whole. Long-run equity return equals initial dividend yield plus growth rate. From 1926 until 2013, for example, common stocks provided an average annual rate of return of about 10%. The dividend yield for the market as a whole on January 1, 1926, was about 5%. The long-run rate of growth of earnings and dividends was also about 5%. Thus, adding the initial dividend yield to the growth rate gives a close approximation of the actual rate of return. Over shorter periods, such as a year or even several years, a third factor is critical in determining returns. This factor is the change in valuation relationship, specifically, the change in the price-dividend or price-earnings multiple. Increases or decreases in the price-dividend multiple tend to move in the same direction as the more popularly used price-earnings multiple. Price-dividend and price-earnings multiples vary widely from year to year. For example, in times of great optimism, such as early March 2000, stocks sold at price-earnings multiples well above 30. The price-dividend multiple was over 80. At times of great pessimism, such as 1982, stocks sold at only 8 times earnings and 17 times dividends. These multiples are also influenced by interest rates. When interest rates are low, stocks, which compete with bonds for an investor's savings, tend to sell at low dividend yields and high price-earnings multiples. When interest rates are high, stock yields rise to be more competitive, and stocks tend to sell at low price-earnings multiples. Common stock returns were well below average from 1968 to 1982, when returns were only about 5.5% per year. Stocks sold at a dividend yield of 3% at the start of the period, and earnings and dividend growth was 6% per year, a bit above the long-run average. Had price-earnings multiples and dividend yields remained constant, stocks would have produced a 9% annual return, with the 6% dividend growth translated into 6% capital appreciation per year. But a large increase in dividend yields, a large fall in price-earnings multiples, reduced the average annual return by about 3.5 percentage points per year. A perfectly dreadful period for stock market investors was the first decade of the 2000s. The age of millennium turned out to be the age of disenchantment. At the start of April 2000, at the height of the internet bubble, the dividend yield for the S&P 500 had fallen to 1.2%. Price-earnings multiples were above 30. Dividend growth was actually very strong during the period, averaging 5.8% per year. Had there been no change in valuation relationships, stocks would have produced a rate of return of 7%, 1.2% dividend yield plus 5.8% growth. But price-earnings multiples plummeted and dividend yields rose over the decade. The change in valuation relationships lopped 13.5 percentage points from the return. Hence, stocks did not return 7%, they lost an average of 6.5% per year, leading many analysts to refer to these years as the lost decade. Many analysts question whether dividends are as relevant now as they were in the past. They argue that firms increasingly prefer distributing their growing earnings to stockholders through stock repurchases rather than dividend increases. Two reasons are offered for such behavior: one serves shareholders and the other management. The shareholder benefit was created by tax laws. The tax rate on realized long-term capital gains has often been only a fraction of the maximum income tax rate on dividends. Firms that buy back stock tend to reduce the number of shares outstanding and therefore increase earnings per share and, thus, share prices. Hence, stock buybacks tend to create capital gains. Even when dividends and capital gains are taxed at the same rate, capital gains taxes can be deferred until the stocks are sold, or even avoided completely if the shares are later bequeathed. Thus, managers acting in the interest of the shareholder will prefer to engage in buybacks rather than increasing dividends. The flip side of stock repurchases is more self-serving. A significant part of management compensation is derived from stock options, which become valuable only if earnings and the price of the stock rise. Stock repurchases are an easy way to bring this about. Larger appreciation benefits the managers by enhancing the value of their stock options, whereas larger dividends go into the pockets of current shareholders. From the 1940s until the 1970s, earnings and dividends grew at about the same rate. During the last decades of the 20th century, however, earnings grew faster than dividends. Over the very long run, earnings and dividends are likely to grow at roughly similar rates, and for ease of reading, I have elected to do the analysis below in terms of earnings growth. Long-run returns from bonds are easier to calculate than those from stocks. Over the long run, the yield that a bond investor receives is approximated by the yield to maturity of the bond at the time it is purchased. For a zero-coupon bond, a bond that makes no periodic interest payments, but simply returns a fixed amount at maturity, the yield at which it is purchased is precisely the yield that an investor will receive, assuming no default and assuming it is held to maturity. For a coupon-paying bond, a bond that does make periodic interest payments, there could be a slight variation in the yield that is earned over the term of the bond, depending on whether and at what interest rates the coupon interest is reinvested. Nevertheless, the initial yield on the bond provides a quite serviceable estimate of the yield that will be obtained by an investor who holds the bond until maturity. Estimating bond returns becomes murky when bonds are not held until maturity. Changes in interest rates, bond yields, then become a major factor in determining the net return received over the period during which the bond is held. When interest rates rise, bond prices fall so as to make existing bonds competitive with those that are currently being issued at the higher interest rates. When rates fall, bond prices increase. The principle to keep in mind is that bond investors who don't hold to maturity will suffer to the extent that interest rates rise and gain to the extent that rates fall. Inflation is the dark horse in any handicapping of financial returns. In the bond market, an increase in the inflation rate is unambiguously bad. To see this, suppose that there was no inflation and bonds sold on a 5% yield basis, providing investors with a real, that is, after inflation, return of 5%. Now assume that the inflation rate increases from 0 to 5% per year. If investors still require a 5% real rate of return, then the bond interest rate must rise to 10%. Only then will investors receive an after-inflation return of 5%. But this will mean that bond prices fall, and those who previously purchased 5% long-term bonds will suffer a substantial capital loss. Except for the holder of the inflation-protected bonds recommended in Chapter 12, inflation is the deadly enemy of the bond investor. In principle, common stocks should be an inflation hedge, and stocks are not supposed to suffer with an increase in the inflation rate. In theory at least, if the inflation rate rises by 1 percentage point, all prices should rise by 1 percentage point, including the values of factories, equipment, and inventories. Consequently, the growth rate of earnings and dividends should rise with the rate of inflation. Thus, even though all required returns will rise with the rate of inflation, no change in dividend yields, or price-earnings ratios, will be required. This is so because expected growth rates should rise along with increases in the expected inflation rate. Whether this happens in practice we will examine below. For historical eras of financial market returns. Before we attempt to project future stock and bond returns, let's examine 4 periods of stock and bond market history, and see whether we can make sense of how investors fared in terms of the determinants of returns discussed above. The 4 eras coincide with the 4 broad swings in stock market returns from 1947 to 2009. The table below indicates the 4 eras and the average annual returns earned by stock and bond investors. Era I, the Age of Comfort, as I call it, covers the years of growth after World War II. Stockholders made out extremely well after inflation, whereas the meager returns earned by bondholders were substantially below the average inflation rate. I call Era II the Age of Angst. Widespread rebellion by the millions of teenagers born during the baby boom, economic and political instability created by the Vietnam War, and various inflationary oil and food shocks combined to create an inhospitable climate for investors. No one was exempt. Either stocks nor bonds fared well. During our 3rd era, the age of exuberance, the boomers matured, peace reigned, and a non-inflationary prosperity set in. It was a golden age for stockholders and bondholders. Never before had they earned such generous returns. Era 4 was the age of disenchantment, in which the great promise of the new millennium was not reflected in common stock returns. With these broad time periods set, let us now look at how the determinants of returns developed during those eras and look especially at what might have been responsible for changes in valuation relationships and in interest rates. Recall that stock returns are determined by 1. The initial dividend yield at which the stocks were purchased, 2. The growth rate of earnings, and 3. Changes in valuation in terms of price-earnings, or price-dividend ratios. And bond returns are determined by 1. The initial yield to maturity at which the bonds were purchased, and 2. Changes in interest rates, yields, and therefore in bond prices for bond investors who do not hold to maturity. Era I, the Age of Comfort. Consumers celebrated the end of World War II with a spending spree. They had gone without cars, refrigerators, and countless other goods during the war, and they forked over their liquid savings with abandon, creating a mini-boom with some inflation. It was hard, however, to forget the Great Depression of the 1930s. Economists, those dismal scientists, were worried as demand began to slacken and became convinced that a deep recession, or perhaps a depression, was just around the corner. President Harry Truman was responsible for a widely used definition of the difference between the two. A recession is when you're out of work. A depression is when I'm out of work. Investors in the stock market noted the economist's gloom and were clearly worried. Dividend yields at the start of 1947 were unusually high at 5%, and PE multiples, which hovered around 12, were well below their long-term average. It turned out that the economy did not sink into the depression many had feared. Although there were periods of mild recession, the economy grew at a quite reasonable rate through the 1950s and 1960s. President Kennedy had proposed a large tax cut in the early 1960s, which was enacted in 1964, after his death. With the stimulus from the tax cut and the increase in government spending for the Vietnam War, the economy was robust, with high employment levels. Inflation was generally not a problem until the very end of the period. Investors became progressively more confident. By 1968, P/Es were above 18, and the yield on the S&P 500 stock index had fallen to 3%. This created truly comfortable conditions for common stock investors. Their initial dividends were high. Both earnings and dividends grew at reasonably robust rates of 6.5% to 7%, and valuations became richer, further augmenting capital gains. The following table shows the different components of the returns from stocks and bonds over the 1947 to 68 period. The development of stock and bond returns, January 1947 to December 1968. Stocks. Initial dividend yield 5.0. Growth in earnings 6.6. Change in valuation, increase in P ratio, 2.4. Average annual return 14.0. Bonds. Initial yield 2.7. Effective increase in interest rates -0.9. Average annual return 1.8. Unfortunately, bond investors did not fare nearly as well. For starters, initial bond yields were low in 1947. Thus, bond returns were destined to be low even for investors who held to maturity. During World War II, the United States pegged long-term government bond interest rates at no more than 2.5%. The policy was implemented to permit the government to finance the war cheaply with low-interest borrowing, and it continued after the war until 1951, when rates were allowed to rise moderately. Therefore, bond investors suffered a double whammy during the period. Not only were interest rates artificially low at the start of the period, but bondholders suffered capital losses when interest rates were allowed to rise. As a result, bondholders received nominal rates of return below 2% over the period and real returns, after inflation, that were negative. Era 2, the Age of Angst. From the late 1960s through the early 1980s, accelerating inflation made an unexpected appearance and became the major influence on securities markets. In the mid-1960s, inflation was essentially unnoticeable, running at a rate of just over 1%. When our involvement in Vietnam increased in the late 1960s, however, we had classic, old-fashioned demand pull. Inflation, too much money chasing too few goods, and the rate of inflation spurted forward to about 4 or 4.5%. Then the economy was beset by the oil and food shocks of 1973 to 74. It was a classic case of Murphy's Law at work. Whatever could go wrong did. The Organization of Petroleum Exporting Countries, OPEC, contrived to produce an artificial shortage of oil, and Mother Nature produced a real shortage of foodstuffs through poor grain harvests in North America and disastrous ones in the Soviet Union and sub-Saharan Africa. When even the Peruvian anchovy crop mysteriously disappeared, anchovies are a major source of protein, it appears that O'Toole's commentary had come into play. Remember, it was O'Toole who suggested that Murphy was an optimist. Again, the inflation rate rose to 6.5%. Then, in 1978 and 1979, a combination of policy mistakes leading to considerable excess demand in certain sectors and another 125% increase in the price of oil kicked the inflation rate up again, taking with it wage costs. By the early 1980s, the inflation rate went above 10%, and there was considerable fear that the economy was out of control. Finally, the Federal Reserve, under the leadership of its chairman at the time, Paul Volcker, took decisive action. The Fed initiated an extremely tight monetary policy designed to rein in the economy and kill the inflationary virus. Inflation did begin to subside in time, but the economy almost died as well. We suffered the sharpest economic decline since the 1930s, and unemployment soared. By the end of 1981, the U.S. economy suffered not only from double-digit inflation but from double-digit unemployment as well. The table below shows the fallout in financial markets from the inflation and instability in the economy. Although nominal returns for both stockholders and bondholders were meager, the real returns, after factoring out the 7.8% inflation rate, were actually negative. On the other hand, hard assets such as gold, collectibles, and real estate provided generous double-digit returns. The development of stock and bond returns, January 1969 to December 1981, stock's initial dividend yield growth and earnings change in valuation, increase in P/E ratio, 3.18.0 minus 5.5 average annual return 5.6 bonds initial yield effective increase in interest rates 5.9 minus 2.1 average annual return 3.8. Because the inflation was unanticipated and allowance for it was not incorporated into yields, investors in bonds suffered disastrous results. In 1968, for example, 30-year, long-term bonds offered a yield to maturity of about 6%. This provided protection against the going inflation rate of about 3% and an anticipated after-inflation real rate of return of 3%. Unfortunately, the actual rate of inflation over the period 1969 to 81 was almost 8%, wiping out any positive real rate of return. That's the good news part of this dreary story. The bad news was that there were capital losses. Who wanted to buy a bond yielding 6% in the late 1970s, when the rate of inflation was in double digits? No one. If you had to sell your bonds, you sold at a loss so that the new buyer could get a yield consonant with the higher rate of inflation. Yields rose even further as the risk premium on bonds rose to take into account their increased volatility. To make matters worse, the tax system delivered the unkindest blow of all to bond investors. Even though bond investors often actually earn negative pre-tax rates of return, their bond coupons were taxed at regular income tax rates. The failure of bonds to protect investors against an unanticipated inflationary episode is hardly surprising. The common stock flop was something else. Because stocks represent claims on real assets that presumably rise in value with the price level, stock prices according to this line of logic should have risen also. It's like the story of the small boy on his first trip to an art museum. When told that a famous abstract painting was supposed to be a horse, the boy asked wisely, "Well, if it is supposed to be a horse, why isn't it a horse? If common stocks were supposed to be an inflation hedge, then why weren't they?" Many different explanations involving faltering dividends and earnings growth have been offered that simply don't hold up under careful analysis. One common explanation was that inflation had caused corporate profits to shrink drastically, especially when reported figures were adjusted for inflation. Inflation was portrayed as a kind of financial neutron bomb, leaving the structure of corporate enterprise intact, but destroying the lifeblood of profits. Many saw the engine of capitalism as running out of control, so that a walk down Wall Street random or otherwise could prove extremely hazardous. The facts are, however, that there was no evidence that profits had been sliding down a pole greased by cruel and inexorable inflation, as some in the financial community believed in the early 1980s. As the preceding table shows, profit growth accelerated over the 1969 to 81 period and increased to an 8% rate, comfortably ahead of inflation. Even dividends held their own, rising at close to the same rate as inflation. Movie buffs should recall the marvelous final scene from Casablanca. Humphrey Bogart stands over the body of a Luftwaffe major, a smoking gun in his hand. Claude Rains, a captain in the French colonial police, turns his glance from Bogart to the smoking gun to the dead major and finally to his assistant, and says, "Major Strasser has been shot. Round up the usual suspects." We, too, have rounded up the usual suspects, but we have yet to focus on who shot the stock market. The major reason for the poor equity returns during the 1970s was that investors' evaluations of dividends and earnings, the number of dollars they were willing to pay for a dollar of dividends and earnings, fell sharply. Stocks failed to provide investors with protection against inflation, not because earnings and dividends failed to grow with inflation, but rather because price-earnings multiples quite literally collapsed over the period. The price-earnings multiple for the S&P index was cut by almost two-thirds during the 1969 to 81 period. It was this decline in multiples that produced such poor returns for investors in the 1970s and that prevented stock prices from reflecting the real underlying progress most companies made in earnings and dividend growth. Some financial economists concluded that the market was simply irrational during the 1970s and early 1980s, that multiples had fallen too far.